You know, in the previous discussion about learning to wait for setups, I told you that patience isn't just a virtue, it's a trader's edge, and that edge is tested most during consolidation. Now picture this. A market moves strong, momentum surges, attention floods in, everyone's watching. Then all at once it stops. The energy fades, the chart flattens, and the crowd loses interest. To most, it looks like nothing's happening. But to a trader who truly understands the nature of markets, that quiet is everything. Consolidation isn't the absence of movement. It's the preparation for it. The market doesn't sleep in those moments. It's gathering energy, aligning order flow, recalibrating sentiment. Like a spring coiled tighter and tighter, waiting for the moment of release. And when it does release, that's when you see the real move, the one that defines the trend. Think of a spring resting on your desk. Looks harmless, right? But press it down and let go. It shoots with power. That's the psychology of a breakout, built from the pressure stored during consolidation. But here's where most traders fail. They can't handle the quiet. They get restless. They say, "This market's dead. Nothing's happening. Time to find action." And that's when they lose their edge. Because trading isn't about constant movement. It's about aligning with probability. Timing doesn't come from chasing. It comes from the ability to sit still when nothing's yet confirmed. So ask yourself, can you stay centered when the market goes quiet? Or do you chase the illusion of action because stillness makes you uncomfortable? The reason most traders never succeed is because they misinterpret consolidation. They think it's the end of the move, a signal of exhaustion. But in reality, it's the market balancing energy, seeking equilibrium before the next expansion. If you don't recognize that, you'll always act too soon or too late, always out of sync. When I observed price behavior early in my career, I noticed something consistent. The biggest winners, the trends that doubled or tripled, never moved in straight lines. They advanced, paused, consolidated, and then advanced again. Each pause wasn't weakness, it was recalibration. During those pauses, the market was engaged in an internal dialogue. Is this price fair? Too high? Too low? And while the crowd debated, professionals were quietly positioning. Money isn't made by chasing volatility. It's made by recognizing the moments when volatility is about to return. The professional doesn't judge a pause. He observes it. He doesn't need the market to move every minute. He waits for alignment. You wouldn't judge an athlete's power while he's resting. You'd watch how he moves when he acts. The same applies to a market. The stillness tells you nothing about strength. The breakout that follows reveals everything. That's why the calm before a move is more valuable than the move itself. It defines the quality of what's coming. Consolidation matters because it exposes the difference between amateurs and professionals. The amateur seeks constant motion. He trades from boredom, fear, or the need to feel involved. He looks at stillness and calls it dead money. The professional looks at stillness and calls it potential energy. It's the same chart, the same price, but two completely different mindsets. Which one are you? Consolidation is the market's way of testing your psychology, your patience, your discipline, your ability to trust the process. Because trading success doesn't come from taking every trade, it comes from taking the right ones. This is where that earlier lesson, waiting for setups, comes to life. In consolidation, that principle is tested. You either learn to wait through uncertainty or you surrender your edge to those who can. Here's a truth I learned through experience. The market never rewards restlessness. It rewards alignment and self-control. When you watch a stock moving sideways, what you're seeing isn't stagnation. It's balance. Buyers and sellers locked in equilibrium, each testing the other's conviction. The range tightens, volume contracts, and price compresses into a corner. When that balance breaks, energy releases, and that's where fortune is made. Not because you guessed, but because you waited and observed. Ask yourself, can you endure waiting without losing faith in your process? Most can't. They lose patience right before probability shifts in their favor. They sell just before the expansion, and the market moves without them. How many times has that happened to you? Be honest. That sting, that frustration, isn't random. It's the cost of misunderstanding consolidation. The calm before the breakout is like the still air before a storm. If you've been through enough, you can feel it, the subtle pressure, the tightening rhythm, the stillness before release. The tape whispers before it shouts. If you know how to listen, you can sense it. The narrowing range, the smaller candles, the fading volume. These are not signs of death. They're signs of preparation. The market is whispering. Supply is drying up. Be ready. When a market runs hard, everyone piles in. Early buyers, late chasers, emotional participants. But when the run ends, something natural happens. Those early buyers take profits, late chasers get trapped, and new buyers wait for confirmation. The result is consolidation, a necessary clearing process. Each small dip shakes out weak hands. Each minor rally triggers premature hope. Day by day, sellers exhaust themselves. Volume contracts because there's simply less fear, less urgency. That's why during consolidation, the daily bars shrink, the ranges tighten, and activity fades. It's not randomness, it's psychological equilibrium. The selling pressure is being absorbed. What remains are traders confident in their positions, unwilling to sell cheaply. That's why the chart looks quiet. It's digestion, not decline. How many times have you exited a position during one of these quiet spells, convinced the move was over, only to watch it explode days later without you? That's the penalty of misreading stillness. You saw silence and assumed weakness. The professional saw silence and recognized readiness. The biggest moves rarely come when everyone's shouting. They come when no one's watching, when volume is light, when attention has faded, when emotional noise has died down. That's the moment when true probability shifts in your favor. I learned this by watching price and volume interact for years. The greatest trends, the stocks that became legends, all had resting phases, surges followed by tightening ranges and declining volume. At first, I misread that calm as disinterest, but then the breakout would come, with explosive force. It was then I understood. Quiet isn't weakness. It's the market rebalancing. It's the absence of resistance. It's order, not chaos. The message was clear. A market cannot advance when too many participants are still willing to sell. Every attempt higher meets resistance. Every rally gets sold into. But once the supply is absorbed, once sellers are exhausted, the path forward opens effortlessly. A little buying pressure suddenly pushes price higher, then higher again, because the weight of opposition is gone. That's why the drying up of volume is one of the strongest signals that energy is building beneath the surface. Let me put it simply. You don't want heavy activity during consolidation. If you see strong volume, it means emotion is still present, imbalance unresolved, and equilibrium not yet restored. But when the noise fades, when participation slows, when the market looks lifeless, that's the real clue. It means the imbalance of fear and hope has settled. Weak hands are out, emotional traders have left, and what remains are participants aligned with the trend and patient enough to wait. That patience, Psychological stability in the face of stillness is the foundation of every great trend that ever unfolded. Do you see how this connects to your mindset? Most traders crave stimulation. They want action, motion, feedback. But the market doesn't reward excitement. It rewards neutrality and discipline. If you sell out simply because the market goes quiet, you'll end up handing your position to the trader who knows how to wait. He sees what you miss. He recognizes that the absence of activity isn't weakness. It's balance being restored. Picture a great oak tree. In summer, it's alive, full of motion and color. Then winter comes. The leaves fall, and it looks lifeless. But underground, the roots are still growing, drawing strength, storing energy for the next season. That's what consolidation with contracting volume really is, the winter phase of a trend. It looks dormant, but beneath the surface, the market is preparing its next expansion. If you mistake that dormancy for death, you'll never be part of the next spring. So let me ask you this. When you see a market trading in a tight range, volume shrinking day by day, do you walk away or do you wait? Because that one choice often determines whether you capture the next big move or miss it completely. It's not enough to know where price has been. You must interpret what the volume and tempo of participation are saying about where it's likely to go. Contracting volume isn't silence, it's information. It's the market communicating that selling pressure is fading, that equilibrium is near, that the probabilities are shifting. In my own experience, I came to value those quiet periods more than the loud ones. The tape would grow so still you could almost hear your breath. And that silence was worth more than any rally because rallies can deceive. But prolonged quiet with contracting volume never lies. It represents balance, compression, and stored energy. It's strength disguised as weakness, preparation hidden behind boredom. That's why amateurs and professionals see two completely different things on the same chart. The amateur sees quiet and thinks, nobody cares. The professional sees quiet and thinks, no one's left to sell. The first acts from impatience. The second acts from understanding. And when the breakout comes, that difference in mindset becomes the difference between regret and reward. And here's something else. When the breakout finally does arrive after contraction, the move is often explosive. Why? Because the resistance has been cleared. Buyers are no longer pushing against a wall of sellers. Price moves quickly because there's nothing left in its way. That's when you see gaps, surges, sharp expansions that catch the unprepared off guard. The public, who ignored the market during the quiet phase, suddenly rushes in, adding emotional fuel to a move the professional has been waiting for. But by then, the professional is already positioned, already aligned, because he understood the message of quiet accumulation. This concept is at the very core of consistent trading. Profits aren't created by reacting to motion. They come from anticipating balance. The trader who understands volume contraction knows where to focus while the crowd is distracted. He knows boredom is the market's disguise, and behind that disguise lies the setup that matters most. But to access it, you must have the mental discipline to do what almost no one can. Sit still, stay patient, and trust the process. Because every great breakout in history, every sustained trend, began the same way, with contraction, stillness, and preparation. The pattern is timeless because it's not about the market. It's about human nature, written on the chart. And until you train yourself to recognize it, you'll keep entering too soon and exiting too early. Forever reacting instead of aligning. Patience through consolidation is the true test of psychological mastery. Anyone can chase a hot market when prices are moving fast, when the headlines are loud and the stories sound convincing. That part is easy. The world loves excitement, and the illusion of effortless profit seduces the crowd. But when the chart flattens, when the tape slows, when it feels like nothing's happening, that's where the test begins. This is where traders lose control, where emotions overtake structure. A trader buys on strength, feels momentum, then the energy fades. The range narrows, volume dries up, and the feedback loop he depended on disappears. Suddenly, he feels uncertainty creeping in. The mind whispers, maybe I should put this money to work somewhere else. And more often than not, he does just that. Sells out of boredom, out of discomfort, out of the need for relief. Then, days later, the market explodes, and the move he waited for finally arrives, without him. Have you lived that cycle? Bought with confidence, grew restless, gave up, and then watched the breakout you'd been waiting for unfold just after you exited? Every trader has. That sting, that disbelief, isn't bad luck. It's simply the cost of not mastering your state of mind during equilibrium. The market isn't cruel. It's indifferent. It rewards presence and punishes impulsiveness. Consolidation isn't punishment, it's preparation. A market doesn't trend in straight lines, it moves in waves. It expands, pauses, regroups, and expands again. Those pauses are necessary. They clear emotional excess, absorb leftover supply, and create the structure for the next move. Without them, no trend could sustain itself. So when you encounter consolidation, never mistake it for wasted time. It's the universe of trading teaching you the ultimate truth, that patience, not action, defines your success. You must think of consolidation as the market's way of building pressure, loading the spring, and the trader who can remain balanced through that stillness will be present when the spring releases. But waiting isn't natural. It goes directly against human wiring. Humans are built for action, for stimulation, for progress. We equate movement with success and silence with stagnation. The market knows this. That's why it uses time as its greatest psychological test. It doesn't always shake you out with volatility. It often wears you out with boredom. It tests your discipline, not in moments of chaos, but in moments of silence. Can you sit calmly when there's nothing to do? Can you maintain conviction when the tape is dull? Can you resist the impulse to act simply because you feel the need for activity? Those questions sit at the core of trading mastery. Think about it. If trading success were only about spotting opportunities, every trader would be wealthy. Charts are public. Breakouts are visible. Trends are obvious in hindsight. The reason most fail isn't blindness, it's impatience. They can't wait. They crave action every day, and because they can't endure stillness, they miss the real moves when they finally come. The market breaks out, runs without them, and they tell themselves, I'll catch the next one. But the next one repeats the same story. This all ties back to mindset. Trading isn't about activity, it's about alignment. Your job is to align with the rhythm of the market, not your internal craving for excitement. The market doesn't respond to your boredom, your frustration, or your need to do something. It moves when it's ready, not when you are. Consolidation is simply the market's way of saying, not yet. If you can't accept that, you'll keep paying the tuition again and again to those who can. Now let me ask you, what's harder, buying a breakout or holding through consolidation? Most will say buying the breakout because it takes courage to pay up. But the truth is, holding through consolidation is harder because it's in those quiet stretches that doubt creeps in. You question your setup, your story, your decision. You start to feel the pressure of time, Your capital feels idle. You wonder if it could be doing more elsewhere. That slow psychological erosion tests you more than any sudden drop ever could. Yet those who endure it, those who can wait without needing reassurance, are the ones who profit. Patience in trading isn't passive, it's active awareness. It's the deliberate decision to not act when acting would violate your edge. The amateur mistakes inactivity for weakness. He believes if he's not trading, he's falling behind. The professional understands that waiting is part of execution. The real work isn't in chasing every move, it's in holding through the quiet when the market is storing energy. When you learn to wait through consolidation, something internal shifts. You stop needing the market to entertain you. You stop micromanaging every tick. You begin to see structure where others see boredom. The tight ranges, the shrinking volume, the quiet tape, all become information, not frustration. You realize the stillness carries as much truth as the movement. That realization separates the trader from the gambler. The gambler needs action. The trader needs alignment. Think of the great campaigns throughout market history. None were smooth, uninterrupted climbs. Every great move had long pauses, stretches of silence, consolidation phases that tested patience. Those who stayed disciplined through those pauses captured life-changing trends. Those who sold in boredom settled for scraps. It was never about who saw the trend. It was about who could sit through the quiet. You might recall from the earlier lesson on waiting for setups. The best trades are few, and your job is to save capital and focus for those moments. Consolidation is that principle in motion. A true setup doesn't appear overnight. It matures slowly, over weeks or months. And your ability to stay present through that process determines whether you participate in the breakout or watch from the sidelines. So I'll ask you plainly, do you have the discipline to wait, or do you need the market to move daily just to feel alive? Because if you need constant movement, the market will drain you. It will use your impatience against you. But if you can sit quietly with conviction, capital steady, mind neutral, like a hunter waiting for alignment in tall grass, you'll find that the biggest profits don't go to the busiest trader, but to the calmest one. Professionals accumulate quietly during the quiet phases. That truth is the essence of why consolidation matters, and why most never see it. When the crowd sees a market drifting sideways, they see nothing happening. They see boredom, wasted time, dead money. But the professional, the one who understands both price and psychology, sees something entirely different. He sees accumulation. Now, what does accumulation truly mean? It's not loud. It's not obvious. It's not something you'll hear about on the news or see hyped online. Accumulation is subtle by nature. It's the patient process where capital transitions from emotional hands to strategic ones. The strong players, the institutions, the experienced traders, they're not chasing breakouts. They're positioning during boredom. They don't do it all at once that would alert the crowd. They do it gradually, methodically, letting time disguise their intent. On quiet, weak days, they add. On stronger days, they pause, letting sellers come to them. Step by step, order by order, they absorb supply. And to the casual observer, nothing appears to change. But to the trained eye, everything is changing. When a market surges and then pauses, there will always be sellers. Early participants take profits, latecomers panic, the restless exit because nothing's happening. All of that supply must be absorbed before the next expansion can begin. So who's on the other side of those sales? It's not the amateurs, they're the ones selling. The buyers are the professionals, quietly accumulating what others discard. And how do they do it? They don't chase. They let price come to them. They spread their orders across time, concealing intent. They know their own participation can distort the market, so they act with patience and precision. That's why, during these periods, price seems stuck, dull, directionless. That's the camouflage. That's the trap. Have you noticed how the biggest moves always seem to come out of nowhere? After long periods where nothing seemed to matter? That dullness isn't coincidence. It's the signature of accumulation. Professionals don't want attention. They want time. They want the public bored, disengaged, and selling for emotional reasons. The fewer participants watching, the easier it becomes to accumulate without competition. And by the time the breakout arrives, the professionals are already in position, calm, patient, ready, while the crowd scrambles to buy back what they sold in frustration. So ask yourself, when you see a market drifting sideways, do you assume it's finished? Or do you pause and ask, who might be taking the other side of these quiet trades? Because someone always is, and if you don't know who it is, it might be you, handing your shares to a trader who understands patience better than you do. The discipline of recognizing and trusting accumulation is something that comes only through observation. Hours, days, years of watching price and volume interplay. The rhythm is always the same. Price surges, then pauses. Volume contracts. The tape grows quiet. Each burst of selling is absorbed, not aggressively, but steadily. Then when the supply is exhausted, price expands again. To the untrained observer, it looks sudden. To the prepared mind, it was inevitable. And this is where psychology returns to center stage. The public hates to wait. They crave quick validation. When the pace slows, they look elsewhere. They abandon quiet winners for noisy distractions. That's precisely what the professionals want. Every share sold out of boredom becomes another share, accumulated with discipline. That transfer, impatience to patience, emotion to control, is the essence of accumulation. Now let's talk about why this process is so powerful. When enough supply has been quietly absorbed, the balance flips. Sellers are gone. The float now sits in the hands of participants, aligned with higher prices. So when new demand enters, there's no resistance left. Price doesn't grind, it jumps. That's why breakouts from accumulation bases are so explosive. They aren't random. They're the logical conclusion of balance being restored. You might wonder, how can you tell when accumulation is happening? You won't read it in the news, you'll see it in behavior. Volume contracts as the range tightens, yet every dip finds support. Price refuses to break down. Weakness is absorbed without panic. That's the silent signature of accumulation. You've seen it. Markets that just won't go down no matter how negative the news. That quiet resilience isn't coincidence. It's accumulation in progress, strong hands replacing weak ones. Professionals play the long game. The public plays the short one. When the breakout finally arrives, the professional doesn't chase. He rides. Because he was already positioned before the noise began. This is the essence of wealth building and trading. The big money isn't made by reacting to the move after it starts. It's made by recognizing the foundation, by seeing accumulation for what it is and aligning early. That kind of understanding requires patience, awareness, and the courage to act when everyone else has lost interest. It requires the confidence to position yourself when nothing seems to be happening, to sit quietly while the market does its internal balancing, and to wait until price reveals its intention. Most traders can't do that. They need movement. They crave stimulation. They associate activity with opportunity. And because of that, they miss the very process that creates the big opportunities. You must learn to value those quiet periods, not fear them. They are not your enemy. They are your edge. While the crowd yawns, gets restless, or sells out of frustration, you must ask a better question. Who is quietly taking the other side of all this selling? Because that's where the intelligent capital is. That's the company you want to keep. Consolidation isn't inactivity. It's stored potential. It's energy collecting beneath the surface, waiting for a catalyst to release it. Most traders, especially the inexperienced, look at a quiet market and dismiss it. They say, "This thing's dead. Nothing's happening." They close the chart, or worse, they sell their position simply because the market has stopped giving them excitement. But that stillness isn't the end of a move. It's the most important phase of it. It's the market resetting probability, rebalancing sentiment, and loading pressure for the next expansion. It's the bow being drawn before the arrow flies. It's the coiled spring gathering power. It's the inhale before the exhale. The human mind is conditioned to chase motion. We feel engaged when prices swing, when the tape buzzes, when the noise keeps us emotionally stimulated. But that noise is deceptive. It's only half the picture. The real work, the work that leads to sustainable wealth, happens in the spaces between movement. It happens in the compression, when price tightens, when volume dries up, when volatility fades. That's not absence. That's accumulation of probability. That's where energy builds beneath the surface. That's where structure is created for the next directional move. Think of a spring lying on your desk. At rest, it looks harmless. No energy, no force. But compress it, add pressure, and what you've created is stored potential. The moment you release it, it explodes with direction and speed. That's precisely what consolidation is in the market, a compression phase. The tighter and longer the price remains contained, the more energy builds for the next release. Have you noticed how some of the strongest, most explosive moves come straight out of the dullest, most forgotten stretches? A market that no one's paying attention to suddenly rips higher, shocking everyone. That move doesn't appear from nowhere. It's the inevitable release of energy built during stillness. Every sideways tick, every narrow candle, every low-volume session is another coil tightening the spring. And when the pressure can no longer hold, the expansion is powerful because it's fueled by equilibrium breaking. That force, that shift in balance, is what separates a temporary pop from a meaningful trend. Now here's where most traders fail. They misread the quiet. They see low energy and assume it's weakness. They think the lack of motion means the demand is gone. But demand doesn't disappear. It waits. During consolidation, the market is not devoid of interest. It's full of it, just not the emotional kind. The buyers are still there, but they're strategic. They're waiting for the right time, allowing supply to clear without chasing price. That's the psychology behind the pause. Consolidation gives the market time to breathe, to reset expectations, to absorb imbalance, to create the foundation for the next move. And understanding that, recognizing that the pause is part of the move, is what separates the professional mindset from the emotional one. The professional doesn't demand that the market entertain him. He allows the market to do what it needs to do: build energy, reprice balance, and signal when probability is once again in his favor. The amateur can't stand the silence. The professional thrives in it. That's why waiting through consolidation isn't passive. It's strategic. It's not doing nothing. It's doing the one thing that most can't: staying aligned when the market seems still. The compression phase is the invisible work of the market. It's where patience meets preparation, and where those who understand timing position themselves long before the crowd even realizes what's coming.